I guess, yeah, this is so we'll start with, this is Mandon Foley.
Mandon Foley, hey.
There you go. Yeah, no, it's a little different when you don't have an intro when, speaker. So I'll cover some of the stuff in the intro, in my own intro for myself. So my name is Mandon Foley. I have an agency for American Family Insurance in Tacoma. We are celebrating our 10th year in business, which is awesome. So we started a business in 2006 when the economy wasn't doing all that hot and businesses were going out of business and we were getting into it. So we got in, put in a lot of hours and structured the business to take care of clients. American Family Insurance has been great. They've had good products, they had good pricing, they had, it's been a great partnership with them. And I've learned a lot over the years, and a lot of what I learned through mistakes, and as we all do. And so people say, "Oh, you seem to know what you're doing." I say, "Well, I tried harder, and I made more mistakes than anybody else, and so I learned a lot." So today I want to teach you guys some stuff about insurance that you may or may not know, or you may have questions on. I do a lot of insurance reviews, and when I'm sitting down with people, or even when they call or having conversations, everybody says, "My rate keeps going up." And it doesn't matter if they're my customers or somebody else's customers. Somebody may come to me and like, "I want a quote on some insurance because my rate keeps going up." And I don't, I fight back the instincts of a salesperson, be like, "Well, you're not going to run into that with me. Come on over. Let me see what I can do for you." No, I tell them the truth, and the truth is, things are different now with insurance. The rates going up is kind of normal. Just about every company that I've seen the reports are on in Washington, the rates are going up. So if you think about everything that insurance pays for, all those things are going up. Your medical bills, the medical services, all of that stuff's going up. Attorneys aren't getting any cheaper. Repairs on the vehicles aren't getting any cheaper. Now it's getting to the point where the sensors in the cars for automatically stopping the car when you don't put your foot on the brake, but the car is going to put its foot on the brake for you. Those sensors are up in the windshields, and they're in the bumpers. And now a windshield could be $2,000 because you have to have the windshield replaced, and you have to have those sensors recalibrated by the dealership. So windshields, which have been $200-ish, with some expensive ones that are pushing $800, now are going to be, astronomical. So everything that insurance pays for is getting more expensive. So, yes, sir, in the back.
Outside of that, though, those things are being pushed by the Insurance Traffic Safety Commission, or whatever they call themselves.
Yes.
They supposedly can create less accidents that the insurance company has to pay for.
Correct.
I'll let you talk about that.
So, well, no, that's good. Insurance companies invest millions and millions into research and development of things that can save people and cost the insurance companies less money. And so insurance companies are pushing for that, because if we can pay out less money, we can charge less money, and the rates will be more stable. And it's the right thing to do, because anytime you can save people, it's good PR.
It's nice side effect.
Yeah. But how do we get someone's rates? Because there's a big variance between companies and rates, and how do you determine a rate? And that is what's changing very fast with the data that's available. Technology is allowing companies, when all the cost of the things that insurance pay for is going up, how do we hedge that increase so that it's not just costing everybody more money? one's safer cars. So in an accident, maybe even though the medical bills are higher, maybe there's less medical bills because the car prevented an accident itself. But then on the other hand, then you have a car that just got wrecked that's more expensive to fix too. So it seems to, there's some things go up, they go down, but what keeps getting better is the amount of information that we have. So how do we determine a rate? Age. Insurance is so there are a lot of things that you cannot determine the price of your product on that insurance can. How old you are, what sex you are, maybe what you do for a living. There's those are untouchable zones to almost every other industry except for insurance. But the way that insurance used to be, it was just a driving record, And so I hear that a lot. I haven't gotten any tickets. Why are my rates going up? Or, and I get to have the conversation that, there's a lot of things that are involved, and then point out all the other discounts that they are getting. It's kind of, if you are getting all the discounts and you don't have anything falling off, the only place for it to go is up. The information, I want to touch on that because it's kind of crazy, some of the stuff that is available now. But insurance companies aren't looking at your driving record because if you have a ticket, it costs the insurance company more money, so they're going to charge you more. The reason why they look at your driving record is to see characteristics of a person. So if you have speeding tickets, you're more likely to get in an accident, and the accident is what costs the insurance companies money. So you get charged more because of the ticket, because it's a characteristic, and it makes you a higher, statistically you're more likely to get into an accident, which costs the insurance company money, and that's the direction it goes. So some things in the past 5 years have been introduced to rating your insurance that a lot of people don't agree with, but the numbers don't lie. I read an article that it's indisputably accurate credit. Somebody's credit, statistically, if somebody that has bad credit is statistically more likely to get into an accident. Yes?
What level constitutes bad credit according to the insurance commissioner or whoever sets that?
So there's no level. It's not like lending money, because the credit bureau, the three major ones, they give you a score, the Beacon or a FICO or the score, and that's been structured on lending money over the years. So the higher the FICO, the higher the Beacon, you qualify for more loan programs, right? And so you will find that, the higher the credit score, generally that person's going to have better credit and be a lower risk and get cheaper insurance. But we don't base it off of that score, because that score, its algorithms are generated for lending purposes. And we're looking at risk. So we look at different things. So there's no, like if you have a 700, you're going to get a 20% discount on your insurance, because they're looking at characteristics of risk. So you could have somebody with a bankruptcy and a lot of old stuff that they have, let's say, a bankruptcy a few years ago, and since then they've got some loans they've reestablished and they got their credit score up. All of those old characteristics are still there. So although they may qualify for a great loan again, those characteristics will still affect your insurance, because we're not lending you money. We're not giving you a better rate because of your probability to pay your bills. It's about getting in an accident. So, and the data, it is one of the most accurate ways to analyze a risk. And even our company was one of the last companies to jump on board that ship. But you know, you let some of the pioneers try stuff out, and if it doesn't work, we'll let them lose the money. But it's not going anywhere, and so it's important that people know that it does affect your insurance.
Well, Ken, what I'm inferring from what you're saying there is that if you see someone who has a less than optimal credit rating, you're kind of making the natural jump there. Well, maybe this person isn't all that responsible in other areas in their life, which means they don't drive responsibly. Is that kind of the jump that the insurance industry makes?
That's exactly correct, but it's not a jump. It's statistical proof. It's
the conclusion you're drawing.
Yeah, exactly. Yeah,
Well, it's a large sample set that person falls within.
it's
Statistical proof.
yeah, and so more in what there are so many different factors. That's one factor. You know, your driving record, you know, is a factor. Your credit's a factor. Where you live is a factor.
Yeah, that's what I'm asking you, in reference to the state. LA may be different than Washington or Omaha, Nebraska, in reference to the population.
A recent article I read, right along with that, Philadelphia. Was Philadelphia?
South Chicago.
I just had it up actually. Allstate did a study. And I think I can. Yeah, it was Philadelphia. Yeah, here we go. So, in 2012, Allstate did America's Best Drivers Report and examined the rates of auto insurance in 200 cities across the U.S. And Philadelphia, their statistics, everybody, your likelihood of having an accident, you are going to have an accident every 6.1 years in Philadelphia. Yeah, that's 64.1% higher than the national average. And so the people in Philadelphia, they pay more for auto insurance because I don't know that's part of the data, but I don't know what's causing that in Philadelphia. I have no idea. Maybe it's because the sun comes across and everybody's eye is longer and they get in an accident. Maybe it's just careless people. I don't know. But down to the area that we're living in, not just state, not just city, but each city is broken down, and the more data that everybody's collecting allows all of that to be more pinpoint, down to possibly what block you're on in your city can determine the rates. So it's not just your age. So you used to be in insurance put in these big, huge groups of people, and it's like, well, why am I grouped together with these people? People with DUIs, for instance. If you had a DUI, you were instantly put in this high-risk category of people without prior insurance, with like high risk. Well, I think everybody in this room probably knows a great person that got a DUI, or that maybe is a very low risk, maybe no tickets or accidents, but maybe had more than the legal limit, and got pulled over and got a DUI. So there are those type of people all over the place. Well, now with all the information and all the data that insurance companies can gather outside of just that one incident, you can have somebody that has a DUI and they're going to pay more for that, but they're not going to be in this gigantic group of high-risk drivers. They are going to pay more because they are they're obviously making some different decisions in life that make them a higher risk, but they're not going to be grouped in this gigantic category. So the area that you live in, how old you are, your driving record, your credit, what type of car obviously makes a difference, but not only what type of car, but each category of your coverage. It's not just one big policy. Each one coverage is individually rated for what type of car you have. So you have bigger trucks that might have a higher liability cost because they can do more damage to other people. And then those trucks also might cause less damage to the people in the car because they're safer. But they also, and so or a car might have better safety features, but it's a Mini Cooper. Maybe it's smaller, so the medical coverages might be more expensive for that car, but the liability might be less because you're less likely to get, and there are a lot of different factors. How many miles you drive per year. So not only, some companies have reports of, so not just what you tell your insurance company anymore. There's reports from data gathered from several different sources, from different mechanic shops, or when you license your car, you get your emissions tested, and they write down the mileage. And so these reports average out the mileage that you really are driving. And they use that. So if you tell your insurance company, oh yeah, I only put 5,000 miles a year, but it shows between your last two emissions tests that you're driving 15,000 miles a year, they could question that if they're one of the companies using those reports. So there's a lot of different factors that now the information is so abundant, and they're learning so much about all this information. Now, not just the DUI people, but everybody is more pinpointed towards you. And you're not just, in such a broad range of a category, it's more to you. So now the distribution of premium is more fair to each individual person. So when your rates that used to be stable for a long time, at one company, those margins are a lot thinner with the new companies. There's a lot more competition. There's not as much meat on the bone, so to speak, for them to just, we'll just keep the rates the same. It's now you're going to see your rates go up and down because the information is there, where you might be a higher risk, you might be a lower risk, and that may change. So some of the things on homeowners insurance have changed too. We see there's been some data that shows the more mortgages you have on a house, you could be a higher risk of having a claim because you're more stretched out. Some more information about different kinds of security. We have discounts now for the Ring doorbell or some of the other preventative security things that you have for a house that before you had to have a monitored system in order to get that discount. But now there's other things like the cameras and smart home technology that allow you to get a discount.
Really tough dogs, is that a discount?
Really? That might actually get you a little surcharge. No. But that's something, pets, and about the information that's available to insurance companies. For the longest time, for the 10 years up until this year, our company, we couldn't even insure a household that had a pit bull, Rottweiler, Akita, Chow, or Wolf hybrid. There still are excluded dogs, but now we can insure houses with pit bulls and Chows and Akitas and Rottweilers. So there's no surcharge for that. But the people that have those dogs, instead of grouping every pit bull owner and every pit bull in the same category as excluded, they have more information. So with our company, and it's still based on underwriting approval, but if you can show that your dog is neutered or spayed, it's up to date on all its shots, and you have a fenced yard, then we can insure your home. So they've taken the data and they've broken it down to not just pit bull owners or Rottweiler, but now, okay, we take somebody that shows signs of a more responsible pet owner, and we can say, okay, now as a company we can insure them. You know, I know a lot of good people with pit bulls, but yeah. Sir in the back, or but
I was just saying, there might be a surcharge for having a dog like that, but at the same time, no one's breaking into my house.
Yeah.
So I'm saving you money potentially.
It's
So what's up?
and so there's no surcharge for it, because we're allowing the normal risk back into the eligibility. So we're not allowing higher risk in there for a surcharge. We've just separated, hopefully the normal risk pet owners with the potential higher risk owners. So you have a male pit bull that isn't up to date on its shots, and it's intact, and which they're more aggressive, that's a much higher risk than the rest of the stuff, or than the latter. A lot of discounts are available now we have more discounts available now than I've ever seen, and most of it's because of information to prove. So insurance is regulated by the insurance commissioner. We can't raise rates without getting approvals from the insurance commissioners. We can't add discounts either without approvals from the insurance commissioner. And we can't say, we just feel like this is a cool discount. No, it's you want to do this discount. This is the proof of why we think this is a less risk, and this is how we're, here's all the data. And so,
They're trying to make sure you're not screwing people, but they're also trying to make sure that you're financially solvent.
yes. I wish they'd, sometimes you can overprotect the people too much to where it actually hurts them too, which I think has happened previously in Washington with the insurance commissioner. So it's like there's a lot of good things, but sometimes it's too much. And then, like the War of the Worlds, once those aliens were exposed to, they hadn't been here for however many years to build up the immunities, and then that ends up killing them because they were separated from the state for so long, or the world for so long. And I think that's sometimes what happens. They're separated. They separate you so long that when something comes up, we don't have the immunities for it, and we end up with 3 companies that can sell health insurance in the state. You can edit that part, right?
Yes.
Is that,
Let's face it.
No, yeah. Chop, chop, chop. Bring it together. All right. So, no, and I think that's it on time. Does anybody have any? Maybe one. I'm good.
I have
No,
a
we're-
question. So
one question.
I noticed a couple of companies are using those OBD2 monitors that they plug in, and
Yeah.
again, is that kind of on an individual basis, or are they taking that data kind of for a whole? But I'm assuming it's for that driver, for that car, you can monitor.
So what that means in regular terms, there's a spot in your car where you plug in a computer to read all its codes and everything. Well, there's information, there's things that the insurance companies have that you can plug that in, And there's per usage basis, so you can get insurance for however you use your car. And then they take all that data and they give you a rate based on, you know, how far you're driving, your average speed, how many stops you're making,
How many
what
0 to 60s you're doing.
what time what time of day you drive, where you drive. I mean, there's a ton of information in there, and so that's one of the ways that technology is being introduced into insurance. So.
The same technology that tells them what happened right before an accident?
They don't get enough. I have never heard of any data that, with most of them that plug into that can help you in an accident, except for, you know, say what speed you were going at.
Well, a few years ago, they were talking about something being put in some cars that would allow them to.
Like a little black box.
Right, exactly.
Yeah. And
allow them to figure that kind of stuff out, and people were saying, hey, I don't want that in my car.
I would predict in the future that manufacturers are going to be putting those sensors into all the cars and probably selling that information to the insurance companies. that would make sense to me. And but
Wondering back on the pets, do they do studies on areas where they have break-ins of the houses that had pets and the houses that didn't have pets?
I'm sure there is. I don't know of any off the top of my head.
It
But
seems to me the ones with pets would have a lot less likely, no matter how big the pet is, just because it's noisy.
yeah.
You know, 'cause they
Oh, yeah.
used to tell you
Oh, they
that
help.
the alarm systems, you know, get a pet and it keeps, in most cases, it'll keep somebody away from just breaking in unless they're serious.
And depends on the dog. So they, you know, that would be a tough one to be able to determine which dog would be a threat and which one wouldn't. You know.
The problem is also how do you prove a negative? You know, if they didn't get broke into, you don't know if they had if they would have been.
Yeah, we do know that when you have a burglar alarm, it doesn't always stop them from stealing your stuff, but it significantly reduces the amount of stuff they can steal, because then it becomes they're in there as fast as they can, and then they're getting out because they know that police are on the way. And so it didn't stop them from breaking in the house, you know, but it stopped them from having all day to shop around your house and load up a truck and, you know, take their sweet time. So, but we're out of time. So, thank you.
Thank you.